After a sharp rally to begin the year, the U.S. stock market has continued to push to multi-month highs, now within about 4% of a record high. So what's next for investors with more than 9 months to go in the year? Chris Hyzy is CIO for Global Wealth Investment Management at Bank of America, joins us now. Chris, let's just get your view from where we stand right now, because I think so much has changed in the last 6 months. We had one of the worst fourth quarters we've seen since the crisis, one of the worst fourth quarters really on record, a furious rally. So as we get to this reset period, what do you make of that action, and what do you see as we look out over the next couple of quarters for investors?
You know, Miles, it's a very good characterization, this reset period, because if you really think about it, this V-shaped sharp rebound recovery, which we've seen in past cycles. A lot of people are going through it right now and saying, I can't believe it. But actually, it's not that uncommon, particularly when you get a liquidity trap. And that's what I think the fourth quarter really was. You know, when there was some non-transparency about the trade agreement and there was some consternation about growth coming down from where it was to it, but the real reason, in our view, is the fact you had a lot of lack of liquidity around the world, particularly the availability of dollars. And just quickly explaining that, when the central bank tells you and forecasts 4 more hikes out over the next 12 months after already hiking, plus balance sheet normalization, and the fact that the ECB is going to go through what they were going to go through in pulling back at least ultra accommodation, that's a signal to the world there's going to be less dollars out there to do whatever you want with them, whether it's transactions, whether it's reserve base, whatever it is. So when you think about that, risk capital has to get pulled back, cost of capital likely to go up, and corporations, which would have put out better CapEx plans, probably said, wait a minute, we're going to wait to see what happens. And that's really what we got. And it happened a lot quicker than most people expected. So this reset period coming back is the fact that we're in the opposite now. There's more liquidity out there than they thought. They're pulling back their forecast. Cost of capital is going down. The dollar is stable. Oil prices have stabilized. And although earnings have come down, there's still this understanding that the cost of capital and financial conditions are a lot easier.
Hey, Chris, I was reading through some of your notes, and one of them that stuck out to me said that you expect 2,900 to be breached this year and the potential for 3,000 if profits are better than expected. In terms of where a lot of our viewers are trying to figure out what to do with their money right now, what sectors or what areas of the market look the most attractive? You know,
it's a tough question if you just look at it and say someone has 100% cash. But if you're fully invested right now, and this is going to sound a little crazy, but if you're fully invested, and you've seen things sharply rebound, and you're above your own policy benchmarks, it's okay to take some profits here and trim. I would do that when you get significant momentum like we've seen recently. 7 out of 8 weeks we're up. However, if you're below and you have not participated and you do have heavy cash on the sidelines, in between earnings announcements is the most optimal way to add into the markets, because you have a spate of news. And the only thing you focus on at that point is high-frequency economics, which will drive you crazy. Or the geopolitical.
Listen to us.
Or the geopolitical equation. So from that standpoint, I would say, what do you do? Outside your core holdings across all asset classes, I think the area of technology is an area that was sold aggressively in the fourth quarter. It's starting to come back right now, and there's a lot in the tech sector. But those companies that are more cloud-based, those areas that are higher beta than the market, but yet the valuations have come way down. Those are the areas I would focus on. And what's acting really well recently is the financials, particularly today.
Well, I also wanted to ask you about what else we've seen working in terms of inflows, right? In terms of the emerging markets looking more and more attractive as we look outside the U.S. What do you think are opportunities there?
The triple whammy for emerging markets is strong dollar, erratic commodity prices, and higher cost of capital in terms of higher interest rates. That was the story for much of the second half of last year. I would argue 9 months of last year. We were overweight in our firm portfolios across the board, emerging markets, and it obviously didn't play out well. We held that overweight into this year. So an area geographically that we would still add to is the emerging markets, because you have the exact opposite now. You have a stable dollar. You have commodity prices that are generally in the sweet spot, and some of them actually upward turning. And then last but not least, you've got a very good outlook on interest rates. So the emerging markets, parts of Latin America, parts of Eastern Europe, but the area that has been most aggressively sold last year and it's coming back is East Asia.
What's the question you're getting most commonly from clients right now, and what are you telling them?
Last year it was, should I be anywhere but the U.S.? Should I be anywhere but technology? And the answer is always, when you get those questions, it's usually at their peak valuations for a lot of things. So you have to think about a full cycle. So full cycle, 6 or 7 years. That's too long for most people in terms of week-to-week gyrations in the market. So think about a three-year investment. If you think about that right now, I wouldn't say go from the U.S. to international, but certainly diversifying across the board. The area I'm still a little troubled by is Europe, even though you're starting to see some improvement. Economic growth, which was completely pushed down almost to recessionary levels in Germany. Germany is a trade haven. So if you think about emerging markets coming back, China stabilizing, Germany's got to be next. So it's probably a second half of the year story, not right now. We're still underweight. But if you think about the biggest question right now that's on the mind, has the market run too far, too fast? In some cases, yes. I mean, there needs to be some consolidation period. You don't just continue to V upward. But I would say this. The kitchen sink in terms of earnings is the first quarter. You're going to see somewhere around 0. Consensus believes negative. We think 0 growth. And then you climb the wall of worry on earnings from there. And when you get liquidity moving first, then you get PE multiple expansion second, then you get earnings later on. And that's what we expect for the rest of the year.
All right, Chris Hyzy, Bank of America. Thanks for stopping by.
Thank you.